Did you know that understanding performance and costs is one of the most critical steps in mutual fund investing? Hi, I'm Pranshumaan and welcome back to our mutual fund series. If you've been following along, we've covered the basics of mutual fund investing and how to choose the right category for your goals. In this video, we'll take it a step further and learn how to evaluate mutual fund performance, understand costs, and navigate taxation. And as always, don't forget to join our Telegram group for exclusive tips and personalized guidance. The link is in the description below. Let's start with the mutual fund fact sheet. This document is your go-to guide for evaluating any mutual fund. It contains all the key details you need, including the NAV or net asset value, which is the price per unit of the fund. Another important metric is the AUM or assets under management. This shows the total amount of money invested in the fund. Generally, a higher AUM indicates investor confidence, but it's not the only thing to consider. The fact sheet also lists the fund's expense ratio, which we'll discuss in a moment, as well as details about the fund manager and their experience. You will also see the top holdings of the fund and the sector allocation, which gives you a snapshot of where your money is being invested. To help you study and understand this better, I'll leave a link to a sample fact sheet from one of the leading fund houses in the comments below. Make sure to check it out. Next, let's talk about performance. One of the most common metrics for gauging performance is CAGR or compounded annual growth rate, which shows the fund's average annual returns over a specific period. For example, over the past 3 years, equity mutual funds in India have delivered average returns ranging from approximately 12% to 18%, depending on the category. Another useful metric is rolling returns. These provide a more detailed picture by showing returns over multiple periods like 1 year or 3 years to help you understand how consistent the fund is. Then there is the Sharpe ratio, which measures the risk-adjusted returns of a fund. A higher Sharpe ratio means better returns for the risk taken. Standard deviation is another metric which indicates how volatile the fund is. And finally, always compare a fund's performance to its benchmark. For example, if you're looking at a large cap equity fund, see how it performed against the Nifty 50 index. A fund that consistently outperforms its benchmark is generally a good sign. Now let's move on to the costs associated with mutual fund. Every mutual fund has an expense ratio, which is a percentage of your investment that goes towards managing the fund. A lower expense ratio means more of your money stays invested. For actively managed funds, this can range from 1% to 2.25%, while passive funds like index funds often have expense ratios below 1%. Another cost to be aware is the exit load. This is a fee you pay if you redeem your investment before a certain period, typically ranging from 0.5% to 1%. Understanding these costs is crucial because even small percentages can significantly impact your long-term returns. Taxation is another key factor to consider when evaluating mutual funds. Recent changes have been made to the taxation of mutual funds in India. For equity funds, if you sell your units within 1 year, the gains are considered short-term and are now taxed at 20%, increased from the previous 15%. If you hold them for more than a year, the gains are long-term and are taxed at 12.5%, which is up from the earlier 10%. Additionally, the exemption limit for long-term capital gains has been raised from 1 lakh rupees to 1.25 lakh rupees per annum. For debt funds, the short-term capital gains are taxed as per your income tax slab if held for less than 2 years. Long-term gains, on the other hand, are taxed at 12.5% without indexation benefits, a change from the previous 20% with indexation. Understanding these rules can help you plan your investments more efficiently and save on taxes. Before we wrap up, here's a quick tip. Don't just focus on past returns. Look at consistency, risk-adjusted returns, and how the fund aligns with your goals. And remember, low-cost funds can often outperform high-cost funds over the long term because every rupee saved on fees is a rupee added to your investment. That's it for today's video. In the next one, we'll explore advanced mutual fund strategies like tax loss harvesting, portfolio rebalancing, and when to switch to debt funds. If you found this video helpful, give it a thumbs up, subscribe to the channel, and hit the bell icon so you don't miss the next update. And of course, join our Telegram group for more insights and discussions. The link is in the description. Don't forget to check out the mutual fund fact sheet in the comments. See you in the next video.